In this episode, Kelvin Massingham will dive into how innovative financial tools such as blended finance, green bonds, and public-private partnerships are unlocking investments in Africa's natural capital. He will explore how these models work and the potential for scaling sustainable finance across the African continent. And today on the set, we have Kelvin Massingham, the Director of Risk and Resilience at FSD Africa. Welcome, Kelvin.
Thanks, Dorothy.
So, Kelvin, you have been an entrepreneur. You have an actuarial background. I know you're very passionate about actuarial science. Why climate and why nature?
I think it's a good question. I think I've always been motivated in my career by impact. I really need to believe in what I do. And I learned that pretty early on in my career. Mm-hmm. I was working for a big South African insurance company developing products for sort of fairly wealthy individuals, and wasn't really fulfilled in doing that. And so from then on, every decision that I've taken in my career has been sort of impact driven. And I think it's only in the last 5 years that I've really been involved in the climate and nature space, mm-hmm. Working for FSD Africa. And I think a big motivation for me is that this is these are some of the biggest long-term systemic risks that we face as humanity. Mm-hmm. And part of the thing is that we actually know this is going to happen. There's not a lot of things that we're pretty certain of in life. We don't know what's going to happen to interest rates or stock prices. We don't know what's going to happen in the American election. There's many things that we're uncertain about, but actually, if you look at the science, we're really certain that the world is warming, that we're heading towards a scenario where things are just very difficult on the planet, and at the same time that we're degrading the nature that we all depend on for life, for our economic activity, at a rate that's really unsustainable. And so the time to act is now. There's an urgency about it. And so being an advocate for that, actually doing something about it, is something that I'm really invested in, passionate about, to create a future for our children, for generations that are to come. You had to bring in the actuarial aspect of uncertainty and certainty. So let's talk about natural capital. Mm-hmm. What is the role of private investors in natural capital? So I think, if you look at the situation at the moment, mm-hmm. And historically, nature has largely been publicly funded.
Yes.
So the type of models that you see is conservation or protected areas. Mm-hmm. And these are public assets. They're funded from fees, like conservation fees and permits and levies and things like this. And so it's been up to the state to finance those things. And there haven't been good examples of how you can marry like a revenue, an asset that's privately investable with biodiversity outcomes. That's starting to change, mm-hmm. And we're starting to see models of that. But we need to see a lot more of that. So if you look at sort of the quantum of nature finance that happens globally at the moment, only 18% comes from the private sector. So it's a very small proportion. And we're way below the levels that we need to be at in order to kind of be nature positive, to be sustainable. And we're probably about 40% of the level that we need to be. And public resources are constrained. Yeah. Especially in Africa where we work. And so we need a lot more private finance to come in. And so we need to find these models where there's a revenue stream. And there are some good examples now. So if there's traditional revenue streams like agriculture or fisheries or forestry where there's a commodity. And if you marry that with ability to demonstrate biodiversity uplift, so you're protecting and growing the environment while you're doing these pretty traditional kind of revenue streams, that is financeable, and you can then claim a biodiversity impact as well. Mm-hmm. I think carbon is a good example. It's a new revenue stream where mm-hmm. we're taking this externality, a ton of carbon, we're putting a price on it and we're including it in the market so that it's tradable like a commodity. It's an asset that can be bought and sold. Mm-hmm. So models like that are emerging that allow us to get private capital in, but the market is very nascent, and that's why there's a lot of work to be done.
Mm-hmm. And speak to us about biodiversity credits. From your experience, what do you see in Africa?
So, I think biodiversity credits have had a huge explosion of interest really
Yes.
since the CBD COP15.
Yes.
And that was because in Target 19, which is about mobilizing finance, there was one of the mechanisms that was mentioned there is biodiversity credits.
Yes.
And so particularly from project developers, you've seen a lot of interest in kind of generating those type of projects.
Mm-hmm.
And we've recently done a landscaping study, which we'll be launching at COP16, the CBD COP16, in a month or two, that really looks at the landscape. And so there are quite a number of projects across the continent, but they're all at a very early stage.
Mm-hmm.
I think the challenge that we see is that in order for there to be a market, you need to both have a seller and a buyer.
Yes.
And at the moment, there aren't really buyers for biodiversity credits. There's not a demand for that as an instrument, and that's really because it's biodiversity credits aren't currently being used as an offset, and we don't really think that they should be used as an offset because there's a number of problems with that in terms of equivalence, in terms of ability to allow companies to continue to degrade in one place and then claim that they're making a benefit in another place.
Mm-hmm.
And so if you remove the offsetting kind of option in biodiversity credits, then you only have two kind of sources of demand. One is where there's like a corporate social responsibility initiative, and they're looking to sort of say that they're funding biodiversity through that. And the other is where there's a business case, where there's an opportunity. And I think for many businesses, there is actually a need to de-risk their supply chains, so especially companies that are in the food industry or the consumer goods industry, where they really highly depend on natural resources as inputs for their products. And they're impacting nature through what they're doing, and also depending on it. There's a need to de-risk that through investing in nature in the supply chains, but we don't see that you would use biodiversity credits to do that, because you would just invest in that yourself. There's an additional sort of cost and layer that would be introduced by doing biodiversity credits there. That's probably not necessary. And so for that reason, there isn't really a use case at the moment for a business or a financial institution to buy biodiversity credits, and that's why we're not seeing any transactions. And it's very, very early on.
And what do you think can be done? Is there anything that can be done on that?
I think that we need standards and frameworks to be developed. I think part of the problem with the carbon markets as they developed is that they're voluntary and so unregulated. And what tends to happen in a situation like that is that commercial interests dominate, and that environmental outcomes can then be compromised.
Exactly.
And so you need the guardrails of policy and regulation. And so before we dive into creating a market, which is much more complex than carbon, and needs much more regulation, I think we need to have the right guardrails in place to establish it. And I think we need the real economy, businesses and financial institutions to properly understand the impacts and dependencies first, so that it creates the demand for actually investing in these things.
So Kelvin, you talk quite a lot about de-risking.
Yeah.
So what is de-risking? And what are some of the de-risking kind of mechanisms that you have come across in the course of your day-to-day work at FSD Africa and across the continent?
So I think, de-risking is important when it comes to creating the right risk-return profile for private investment to come into an asset class. And so we talk about blended finance in that respect, which really means where you take, it's just strategically using public or philanthropic capital to really mobilize private investment into actions that support the Sustainable Development Goals, like nature and climate. And so it's really about, in the capital stack, putting a structure together that creates the right risk-return profile for the private sector. And so there's a number of examples of that. A common one is a concessional or public funder providing a first loss guarantee. So if something were to go wrong with the investment, there'd be a default. They're the ones who take the first hit
Yes.
And so that then provides a safety net for the other investors that have a kind of higher tranche in the capital stack. And another one is guarantees, which really often apply to debt finance, where a public or philanthropic funder can guarantee to the lender that that if something was to happen on a default, that they would be covered. And so these are common types. You can also get like technical assistance that sits alongside an investment that helps to provide the capacity and the development of the project. And so funds that would otherwise have been used for that are not necessary, and so that kind of de-risks it because there's a lower cost of capital.
So Kelvin, we were having an argument the other day, and somebody said that even with the de-risking mechanisms that they exist, you find that the crowding in of capital from private investment is still, private investors is still quite low. And so there's an element of perceived risk. What can you say about that?
Yeah, well, I think you need to understand that where private investors are coming from is a very competitive environment where they have policyholders and shareholders that they're accountable to. They have a fiduciary duty. And so any investment they look at has to produce a return that's commensurate with the risk and that compares to other options. And in many cases, there's a huge amount of capital that exists, in Africa, $2.5 trillion US dollars in assets under management. A lot of that sits in fairly risk-free investments like government bonds, government securities, which in Africa provide a fairly good return. And so when you're talking about other opportunities, they need to compete with that. And given that kind of these nature-based solutions are a new asset class, and financial institutions, businesses are unfamiliar with how to understand them, how to price them. That results then in sort of an additional risk premium that they need to be compensated for. And so even sometimes when there is a de-risking available, it's not sufficient, to really convince them that they need to get involved. And so what we need is some good demonstrations with those that are willing to initially take some more risk, that actually there is a commercial return here and that some of the risk is perceived. And so a lot of the work that we do is trying to create those demonstrations of the commercial case.
And when we look at the continent, is risk-free, government risk-free returns really risk-free?
Well, I think many financial institutions and investors in government bonds are starting to realize that that's not the case. There's been a number of defaults, of downgrades, and so because of the really constrained fiscal space that many governments are in at the moment, that is something that is really concerning to investors, and they're looking to diversify their portfolios as a result. The other thing that we see is also that they're really interested in finding opportunities that align with net zero targets, that align with kind of nature positive objectives, and so there's a willingness to diversify and to allocate capital to these things, but we need to provide opportunities that have the right risk, that have the right return, and where you can credibly demonstrate that these other benefits, like environmental benefits, are actually achieved. I think some of the integrity issues in the carbon market that have emerged over the last 2 years have really caused conservatism from investors and just a hesitancy to really trust without very credible scientific based outcomes being able to be demonstrated.
And I want to draw in the science. Why is the science important? In fact, let me ask, is the science important even for investors?
Yes, because I think if you're going into an alternative asset class, and one of the primary reasons for that, in addition to achieving a return, is because you're concerned about the environment and you want to make sustainable investments. And you're taking some additional risk often in doing that. Then it's very important that you can explain both to your customers, to your policyholders, to your shareholders, that actually that has been achieved. And you don't want the reputational risk that you say you've done something, but actually it turns out that the outcome was
Yes.
very, very different. And so the science is important. And when we talk about nature finance, that's a lot more complex than in the carbon space, where a ton of carbon is a fairly simple metric, but biodiversity is complex, and different biomes have different ways in which you need to measure the biodiversity in that biome, and so that adds a complexity. It means that things can't be easily replicated, and so that's an additional challenge that we need to overcome in order to really see kind of credible, high integrity nature investments materializing.
And Kelvin, really balancing the rigor of science and the practicality that businesses and investors need is not an easy task. What do you think could be done to kind of, bring this to a point where information can be available, the science is credible, but the science is also well understood by those who need to make decisions?
Yes, I think for a marketplace to develop, you need to have a way of connecting the supply and the demand.
Yes.
And at the moment, that in the nature finance space particularly, that's very disconnected. And so you have projects that are really focused on achieving the science and being credible, but are not very able to speak investor language.
Exactly.
How to structure a transaction, how to do business models, demonstrate revenue, answer the sort of risk questions that investors have. And so we really need to capacitate the project, and that's really one of the priority projects that we have within FSD Africa, within our nature program, is accelerating nature-based solution projects through providing that type of transaction advisory to get them investment ready, to connect them with the investors. And so I think that's really important. And I think the same is true for the supply of capital for those that are investing. They're very good at structuring transactions, understanding counterparty risk and credit risk, but they're not so good at understanding the science and the nature. They don't have any background in that. And so they also need to be able to understand what constitutes a really good project that actually we can credibly claim has a biodiversity benefit. And so we need to sort of bring them together on both of those aspects. And I think data and information sharing is also really important for a market to develop. At the moment, what we find is that any transactions happen what we call over the counter. So it's sort of one project and one investor, and they meet together over a counter and do a deal. There's no open sharing of the deals and the supply of finance where they can connect in a marketplace like an exchange. And so we need to create more of that transparency so that things can flow more freely.
And you've talked about a number of challenges: regulation, policy, data. Which other challenges have you seen in the nature finance space?
Yeah, so I think we've talked about a lot of the challenges. I think a big one is kind of this mismatch between the expectations of the investors, which are often sort of hardcore commercial, and the expectations of the projects, and they're coming more from an impact perspective, from we care about the environment and we're on the ground with the communities and we're delivering benefits, and we want to maximize the amount of the project proceeds that go to the community. And these are all good things, but sometimes those are counter to the sort of profit objectives of investors. And so it's kind of finding a middle ground between those two things, I think, is important. I think a big challenge at the moment is the lack of policy and regulation. For investors, particularly, what they want is certainty and transparency. And at the moment, it's very unclear from a government perspective, especially in Africa, how they view these nature markets and kind of what sort of incentives and policies govern them. And so that that creates a political risk. There's often kind of the main barrier, especially for international investors, to come in. And so, we really also need to work on that enabling environment to ensure that there's the certainty for the private sector that doesn't change. I think another challenge is that nature-based solutions require often a high upfront capital investment that it has then a long payback period. You actually just see, to restore biodiversity and protect biodiversity and to demonstrate that in a particular area is a long-term thing.
Yes.
It's not a quick fix. So, you're talking 20, 30, 50 years over which you'll see the payback. And so that sometimes creates a challenge with the requirements of investors. And so we need to find a way of kind of bridging that gap and potentially using insurance solutions to provide certainty that if things go wrong over that long-term horizon, that there's a safety net for the investors, that they can still be compensated.
So there's insurance potential, product potential for insurance. Any examples that you can think of?
Yeah, so I think insurance is underutilized, and what we find particularly in Africa is that there's quite a shallow insurance market. There's not a huge amount of innovation often, and there's kind of new products from the mainstream insurance industry are not often forthcoming. But I think there's a big role, and I think incentivizing the right sort of behavior by communities can really be unlocked by insurance. And an example is maybe on human-wildlife conflict. In many places in Africa, there's this cohabitation of wildlife and communities, and that provides a threat sometimes to their livelihood, to both their crops and their livestock. And kind of communities, if there's not a compensation mechanism, will resort to destroying the lions or the elephants, or whatever that are bothering them. But if they know that if something happens to their crops or to their livestock, and they're covered by an insurance policy, then that provides an incentive to live more in harmony and not to destroy species that are kind of causing issues. So examples like that I think are important. And I think also in getting investment into nature and carbon, sort of it's like another de-risking solution, insurance, and kind of so enabling investors to have confidence that if things go wrong, that the risk is transferred, that they will still be able to receive their return, is kind of an important role that insurance plays.
Yeah, and look at, for example, the early stage, the early stage exploration product or solution on geothermal. Yes. Geothermal these are natural resources.
Yes.
Can you speak about that? What is that supposed to do?
Yeah, so I think insurance plays a really good role where there's a kind of a low probability but high impact event that can be transferred, and that in geothermal drilling, that scenario exists. Once you've established through a feasibility in a particular area the potential for a geothermal well, you then need to drill and get the right kind of temperature and pressure deep down in the earth in order for the geothermal energy to be able to come through and produce electricity. And there's a very low chance that will go wrong. But if it does go wrong, you've burnt like $7 million per drilling well. And so insurance is a good solution to kind of de-risk that for investors. And so we've recently launched an underwriting pool in Kenya to de-risk early stage development drilling. It's a consortium of local insurers that have come together to underwrite this. And so now a big blockage in actually being able to invest in drilling and exploration has been unlocked. And so I think there's many other potential examples and replicability of that type of solution that we need to see in the market.
So Kelvin, assuming we have project developers listening to us, what do you think they would need to know in terms of what investors are looking for?
So I think ultimately investors are looking to see demonstration of revenue.
Yes.
So they need to see a revenue source that's fairly secure, and that they can guarantee, not guarantee, but that is fairly secure over the long term. And they're also interested in liquidity. So are they able to sell this if they need to, and they're interested in kind of the downside risks and how those are mitigated. And so all of those things are really, really important and need to be well communicated in a professional way, in a way that investors can understand.
And what role can organizations such as FSD Africa play in that process?
Yes, I think there's a very important role for donor capital to help develop the market by providing the capacity to these projects. And so, the accelerator program that we are now launching is designed to do exactly that, to provide the technical assistance both on the kind of the investment side, engagement, but also on some of the biodiversity and carbon and legal side, the project development services that are required. And so each project will be different, but has specific needs that they must be met in order for them to get to an investable stage. And so accelerators and kind of grant technical assistance can really be used effectively to help get them to the right place where they can get the investment they need.
So now let's speak to the young professional, straight out of campus, trying to figure out a career. What would you say to them? So
I think that there is a huge amount of opportunity in Africa to be involved in the sustainability space in lots of different career paths. And so, in the financial industry, kind of marrying the financial side with a ecological kind of understanding, with a scientific understanding is a real gap in the market. We need much more of sort of rounded young professionals who understand both sides. That doesn't really exist that much, and so I think there's a powerful opportunity to kind of pursue a career where you're blending those two things. I think we also need engineers and we need lawyers who the supporting functions of the market that understand environmental impacts and are kind of bringing that into their professional advice. And so I think in most careers, given such an important, a vital consideration, that there should be in some of the professional education and the way that you approach your roundedness as a young professional, that you consider these aspects.
So we take a twist and now let's speak to asset owners and asset managers. What are the opportunities in Africa? Are there opportunities?
Yeah, I think there's a huge amount of natural capital.
Yes.
And really kind of leveraging that in a way that also generates economic returns is something that asset owners should look really seriously at. And so part of our role is to try and make them aware of some of the kind of financial instruments that are available to do this. And so things like green bonds, where you go to the capital markets to raise money, but then you use the proceeds of that in green projects. There's a lot of demand from investors, and so it's a good way to raise money. I think conservation bonds, which some of our anchor members are working on, where some of the proceeds from the coupon is diverted to a conservation or biodiversity outcome, and there's an outcome payer who tops up that reduced coupon at the end if the right outcomes are achieved. I think in linking kind of debt finance to environmental KPIs is something that can align incentives. And so if in banks in their lending, if they can introduce performance indicators that are linked to the environment, where the coupon rate, the repayment rate on the bond changes depending on whether you achieve those or not. Mm-hmm. That can really align incentives. And so, for example, as a recipient of the lending, if you're able to demonstrate really credible kind of biodiversity uplift or carbon removals or community benefits over time, then you can pay a lower interest rate, a coupon rate, a repayment rate. Mm-hmm. But if you don't, then you're kind of penalized by paying a higher one. And so that's a way for financial institutions like banks to ensure that they're getting the finance to achieve the right things, but they're de-risking it, because if those aren't achieved, then they get a higher return.
Mm-hmm. When we are still on debt, what about the debt situation in a number of African countries? Any solutions, any ideas on how to use natural capital, for example?
Yeah, so I think there's a number of options.
Yeah.
It is a very, very difficult space, and I think it's probably one of the biggest challenges that Africa faces in terms of development, and that accessing capital at such an expensive rate from the debt markets really inhibits the ability to really grow and develop. And so if there's a way that we can reduce that debt burden and link it to environmental outcomes, that's very helpful. So debt for nature swaps, for example, which have happened in a number of African countries, starting in the Seychelles, are a particularly useful type of instrument where the debt is restructured at a lower coupon and repayment rate, and that saving is put into a special purpose vehicle, which then can be deployed for achieving green outcomes. I think in the same way that financial institutions can include KPIs in their lending, there can be KPIs linked to government lending as well. So that if you achieve certain environmental outcomes, that you then have cheaper financing. So these type of incentive-based lending structures, I think, can be really useful.
You make nature finance sound so simple, and it's a very interesting space. So, Kelvin, if you had a magic wand and all you needed to do was just, flip it, and there would be change, what would that one thing be that you'd want to see?
I think that part of the challenge is that there's a lot of opportunity, there's a lot of projects, but kind of connecting the 2.5 trillion assets under management to those projects is particularly challenging. And I think where the change starts and is really effective is where the leaders of the financial industry, the leaders that sort of own that capital, understand the opportunity, understand the responsibility, and start to drive that change in the organization. And so I think if I was to be able to kind of get a magic wand and all of the CEOs of all of the big banks and financial institutions and businesses were to understand this and to get it and to make it a core part of their strategy, then I think we would see radical change within the industry. And so, I think the ultimate objective is that all of finance is green finance, and that kind of leadership on the continent really understands that. And I think we're off to a fairly good start on that, because we have a number of very significant financial institutions on the continent that are working with African National Capital Alliance, where there is that commitment from senior leadership. But we need to see a lot more.
So I hope the CEOs have heard that. Ladies and gentlemen, Kelvin Massingham, Director of Risk and Resilience at FSD Africa. Thank you so much for joining us, Kelvin.
It's a pleasure, Dorothy.
Oh my God.